Let's now have a chat with Brian Szytel, Managing Director and Partner, as well as Co-Chief Investment Officer at the Bahnsen Group. Brian, good to have you on Open for Business on CNA 938 here in Singapore. Thanks very much for joining us. So US-China trade talks, day 2, big progress, a plan now agreed upon. The next step is to get the John Hancocks of the two presidents and roll that plan out. So looking at the markets, the S&P 500 is close to the record high seen in February. It's currently at 6,038, futures trading at 6,045. So what would this development mean for the equity markets? How much more can it go beyond this 6,000 mark?
Well, I think we could get back to where the previous highs in February, if there's a deal that's done that is good for both sides. And like you've said previously, it's really about what the two countries can't replicate on their own. Technology chips from the US in exchange for a deal on rare earth minerals out of China. But just the fact that these negotiations are positive and progressing is why markets have traded back to where they are now. And I suspect as a deal gets closed, they'll have a little more upside to them. But just keep in mind, we're trading at 22 times earnings already. This is not an inexpensive market by any stretch of any metric that we can come up with. And so this is a time to be selective in what you're going to own versus just hoping the S&P is going to go from 22 to 24 times earnings. I really do think this is a time to be selective and value oriented in the positioning that you take.
Fair advice. And just a reminder here, the S&P 500 record high was 6,144 set on February 19th.
So analysts, Brian, believe there's more upside to be had yet on the S&P 500, even as Wall Street is feeling cautious now. Is the optimism fueled by comparison to the April slide, and that is the post-Liberation Day, or is there a meaningful climb, you think?
Well, it's all going to come down. Once these negotiations take place and we get something between China and the U.S., it is going to revert back to fundamentals, and fundamentals in the U.S. are still very sound. Unemployment is low. You've got credit spreads that came back to just 300 over treasuries, but it's going to come down to fundamentals, and so earnings need to show up. And time will tell whether tariffs get priced in. I suspect they will and get passed through to consumers. But ultimately, we had a Q1 strong earnings season. We were up 14% on Q1. If we get something anywhere near double digits in Q2 and then a positive GDP print in Q2, then I have every belief the markets will trade back to where they were. The question is just going forward a year from now, how much more good things have to happen for it to trade up another 10% from there? And my argument would simply just be selectivity is going to be key.
Brian, there are surveys showing that more American consumers are expecting lower inflation in the next 12 months compared to the previous poll. Bringing this up because we are talking about some of the economic data coming out of the US. CPI coming out later today, PPI out on Thursday. How are you feeling about the inflation story right now?
Inflation is certainly moving in the right direction. There's been a shelter component inside of it, owner's equivalent rent that has been escalated and has started to come down here. I believe that will continue to come back down to reality. It's still printing somewhere in the high fours when in reality, shelter costs are rising somewhere closer to 2.5%. So I think as that comes back to normal, you'll get inflation that continues to go lower. That gives the Fed a little bit more wiggle room to lower interest rates. All of those things should be positive overall for markets. Again, though, it comes back to just where they're already priced and what valuations you're already having to pay to buy them.
Exactly. So you're talking about whether the tariffs or not have been priced in. We'll have to wait and see what Q2 earnings brings us. But what do you think when you're scouring the landscape, so to speak? What are the companies feeling here? Are they feeling like, at what point will they say this is going to hit my bottom line and then I'll pass it on to my customers, my consumers in America? Where are they at?
Well, so Q1, obviously, earnings were great. Like I said, 14% earnings growth. What they did is rather than give hyper negative guidance going into Q2, because CEOs didn't know how these trade talks were going to progress.
Right.
They, in some ways, punted, their forward guidance. And so I think once we get those actual Q2 numbers, we'll know more. All that to say, when you have positive fundamental backdrop and the economy is still expanding, you have low unemployment, you have a very strong consumer. Consumer spending has been strong. we're still optimistic on how those earnings will come in. And what's going to be interesting to us is not going to be what comes out in Q2, because I think there'll be some oscillation around some of this. But I think it'll be more about guidance for Q3 that really tells us and paints a good picture of how companies are dealing with what's going on.
Brian, let's take a look at the US debts now. The CBO estimates that $2.4 trillion will be added to the US deficit. What will that mean for the bond market?
Well, ultimately, government deficit spending is not a good thing for bond markets. You currently have a 10-year Treasury yield that has actually hung in there just fine. We're at 447 as of today. But if you compare that to, say, Europe with a much slower growth paradigm and arguably a slower demographic backdrop to it, yields are half of that, or call it 2.5%. And so there's your answer. It's showing up in what current yields are. When you're running a $2 trillion or just under that government deficit, you have to pay more in interest expense. The only thing I'd push back on is the comments that are in media headlines around, runaway interest rates because debt won't be purchased at all. There's simply a need to solve for future liabilities. The U.S. is still a very, very high credit quality country, and you're getting compensated fairly for the excessive spending that's going on.
And how much of this is related to the Sell America theme? Do you think a lot of that is impacting the bond market?
Marginally so. I mean, at the worst, you had a 30-year yield just breach 5% marginally. If that's what we're calling bond vigilantes coming back out, I think people just need to revert and remember back in 2012 when Greek government bond yields on the 2-year were yielding 200% and Italian 10-year debt was yielding 8%. So all of this is flowing through. You've also seen that show up in just equity indexes too. You've got the S&P up 2.5 roughly on the year, where you have a lot of Europe that's up double digits. And so, again, some of this stuff has been priced in already.
And meanwhile, Brian, the Russell 2000 is underperforming YTD but outperforming large caps this month. So are you seeing meaningful trade volumes moving to small caps?
Trade volumes, no, not as of yet. I, as a contrarian, I'd say there's opportunity in the small cap space, although you've had to been a very patient investor to play out that thesis, because it just simply hasn't materialized much yet. Large caps have still been, by and large, the outperformer. But as you get positive economic growth in the U.S. and as you get interest rates that come down, and small caps are more sensitive to interest rates, you should see that sector start to perform better. And so we're believers in the small cap space.
Brian, want to take a look at the overall seasonality of the stock market, right? I mean, does it still matter if there's the 90-day tariff pause, the trade negotiations going on in the background? I mean, how do we parse historical data to inform what typically should happen in the month of June and beyond? I mean, summer's coming up as well.
Summer's coming up, and historically the adage is sell in May and go away, except for we had a very positive May and the best one since 1990. And so I'm always a little hesitant to say because it's June or the summer or it's this month or that month, this is where the stock market will ultimately go. And
Exactly.
I really do think focusing back on fundamentals is the right way to go here, and that backdrop is generally fairly positive, for us at least.
Okay, so seasonality is still in a little bit of fashion, but not the be-all and end-all. Brian, we'll leave it there. Thanks very much for sharing your thoughts with us this morning. Really appreciate it.